Okay, so I have a question here for this company. We're given their selling price per unit, variable overheads per unit, fixed production overheads per unit. They've told us NBL uses an absorption rate for fixed production overheads and is based on normal capacity of 1,400 units per month. The closing inventory for October 2023 was 100 units. The following is the actual performance for the month of November 2023. Selling price 960, variable production overheads per unit 240, fixed production overheads 624,000, units produced 1,160, units sold 1,140. So we have to determine the gross profit using marginal and absorption. So colleagues, what is the difference between marginal and absorption costing? If anybody remembers, what is the difference? You mean the way we treat inventory, how we value the inventory, okay? Marginal costing, you only value the inventory using variable costs. Absorption costing, you value the inventory with variable and fixed costs, okay? That's the difference. It's all in the valuation of inventory, okay? So the first thing for this question before you do anything is you need to determine what is your opening inventory your closing inventory for the year, for the month actually. Okay. We've been, we are dealing with the month of November. So they told us our closing inventory for October 2023 was 100 units. So what would be our opening inventory, colleagues? If the closing inventory for November is 100 units, of October is 100 units, what's the opening inventory for November? 100 units. Okay. They told us how many units are we producing? 1,160. So 100 plus 1,160, we get 1,260. Now we need to know what is our closing inventory. Okay, so they've told us we are selling 1,140 units. You know, with the calculator, 1,260 minus 1,140. 120 units. So that is our closing inventory. Excuse me. So colleagues, the way you get your closing inventory is just your opening inventory plus your what you produce, and you subtract it from the closing inventory. From what you've sold. Okay, closing inventory equals opening inventory plus what you produce plus production minus units sold. Okay, so opening inventory plus units produced, then you subtract units sold. Any questions on this? Okay, now we'll start with marginal costing, all right? So we have to find what's the total variable cost per unit. Okay, what is the total variable cost per unit? All right, so we come to the information for the actual performance for the month. All right, so we only have variable overheads per unit. We don't have any other variable costs. Okay, sometimes they'll put direct materials, direct labor. Those you can include them. Okay, direct materials, direct labor, and variable production overheads. Okay, now in this case we only have variable production overheads, so variable cost per unit 240 kwacha. Okay, that is our variable cost per unit. Okay, this 240 kwacha. Okay, so as I said, in a question, when you're getting the variable cost per unit, always include direct material plus direct labor plus any variable production overheads per unit. Okay, these are the three that you look for. All right, so in this case they've only given us the variable production overhead per unit. So for marginal costing, that's the total cost to produce one unit. Okay, in this question we didn't have direct materials and direct labor, we just have the variable production overheads per unit. So this 240 is what we're going to use to value our opening inventory, closing inventory, also the units that we produce. Okay. Any questions? No, those are it doesn't include those ones. Those ones they're separate. I would say they are separate because in questions you see direct materials by itself, direct labor, and variable production overhead. Okay, because remember, direct materials and direct labor, those are the direct costs. Whenever you hear overhead, just know that's an indirect cost. Okay, Mr. Austin. Okay. Any other questions? Yeah, it depends what you are producing. I don't know why in this question why they haven't put direct materials and direct labor. So I wonder what they are producing. Yes. Okay. So as I said, these profit statements is similar to the trading account which we learned in financial accounts. Okay, you start with your sales revenue. We see our selling price. Now, colleagues, notice this. The selling price, even though this is the budgeted one and this is the actual one. So you're going to use the actual one. Okay, you are going to use the actual one. Even variable production overheads per unit. This is what's budgeted. Here, this is the actual one. You are going to use the actual one. The only one which you're going to only focus on the budgeted is for the fixed overheads. Okay. For the fixed overheads, as you see, once we come to absorption costing, we're going to use this cost. We're not going to calculate a new overhead absorption rate with this new amount here. But we're going to make that adjustment when you in the profit statement to see if we've under absorbed or over absorbed. So when we come to absorption costing, I'll explain more on that. So take note of that, colleagues. All right, we're using for the marginal costing, we're using the data which has been given us for the actual month. Okay. So in your practice question, I've changed figures. The budgeted and the actual performance, they are different. So focus on the actual performance figures. So selling price 960 kwacha. We sold how many units? 1,140. So we're going to say 960 times 1,140. What do we get? 1 million 24,400. Okay. Okay. Then we say less cost of sales or less cost of goods sold. So we have to tabulate the cost of the goods sold. Okay, so we start with our opening inventory. Opening inventory. Opening inventory is 100 units. So we're valuing it at our marginal cost per unit. Okay. This 240. So this 100 times 240 should give us 24,000. In the trading account, it used to be purchases here. Okay, but here you just put production. Okay, we produced 1,160 units, valued at 240 kwacha per unit. So 1,160 times 240, what do we get? 478,400. Okay, 278. Okay. So we have to add our opening inventory plus the production to get our total cost of goods available for sale. So 24,000 plus 278,400, what do we get? 24,000 plus 278,400. Okay. Now, important point to note. Colleagues, if there were other variable, like let's say variable selling overheads, this is where you include them. This is where you add them. After you get your total cost of goods available for sale. Oh, no, those variable selling overheads. After you deduct closing inventory. After you deduct closing inventory and you've got your cost of goods sold, then if there are any other variable selling overheads or any other variable costs, that's where you include them. Okay. Do not include those other variable costs when you're tabulating the variable cost per unit. Okay. Remember the other question we did? There was another one at variable selling overheads, and we never included it in our variable cost per unit. Those variable selling overheads, we included them after we got our cost of goods sold. So yeah, that's another point to take note of. Because you're only focusing on production costs. Okay, colleagues? For marginal costing and absorption costing, you're just focusing on production costs, which are using to value the inventory. Okay, so you say less closing inventory. Closing inventory is 120 units. We value them at 240 kwacha. 120 times 240. 28,800. Okay, excuse me. 28,800, right? So, okay. So we did, okay. Yes, so we deduct this from the total cost of goods available for sale so that we get our cost of goods sold. So 302,400 minus 28,800, what do we get? Okay. So, as I said, in marginal costing, it's not called gross profit. It is called contribution. Contribution to cover fixed costs. Okay. So the formula is contribution equals sales versus your minus variable costs. Okay. Sales minus your variable costs. So you're going to say contribution. So you see 1,944,000 minus 273,600. What do we get? One million 670,400. Yes. So marginal costing is also called variable costing. Okay, variable costs, these are the costs that you can control. Okay, so for a company, if you see your contribution after you deduct the fixed costs and you see your contribution is failing to cover the fixed costs, colleagues, what is a company supposed to do? If you see contribution is failing to cover fixed costs, what do you think as a manager in the company you need to do? If your contribution is low and it cannot cover fixed costs, we're going to subtract the fixed cost in the same marginal costing statement because marginal costing also separates fixed and variable costs. So this fixed cost which was incurred this month, we need to subtract it from the contribution. But I pose my question again. What if it's a situation where your contribution cannot cover your fixed costs as a company? What do you need to do? Mhm. Wonderful, sir. That's one thing they can do. Reduce the variable costs. Okay. You can try to reduce variable costs either by producing less. Okay. Maybe you find, or maybe you can find a new supplier. Maybe the direct materials that you're buying, they're expensive. You can change. Maybe you can reduce your labor. You can reduce your labor costs also. Although, according to macroeconomics, we know what happens if you reduce people's, you cannot reduce people's pay. So what you can do is maybe reduce the number of people working in there. So you can either reduce your variable costs or you can increase your selling price. So you can try to do both, increase selling price and reduce variable costs. Okay. It all comes down to what this formula is saying here. If you increase your selling price or the number of units you produce, because if you produce more units, it means you make more sales. But the only problem is the more you produce, your variable costs are also going to be going up with your level of production. But if you can increase your selling price, you can have a chance of increasing your contribution. Okay. Or if you reduce your variable costs, that also can be another way you can increase your contribution. Or you can try to do both. But it's not easy because this is just theoretical, colleagues. In real life, it's not really easy to just increase your selling price just there and then. Okay. All right. So we deduct our fixed costs. So it's a less fixed costs. So we have these fixed production overheads here. These production overheads, 624,000. Okay, so 1,067,400 minus 624,000. What do we get? Hello, are we there? 443,400. Yes. Colleagues, are we all getting this? Mm, okay.